2023 also looks like a year of diversification where you can go slightly higher in your debt when your portfolio is concerned. What can be the best pick in debt, considering the kind of financial goals people come up with on the show, keep asking, how should one diversify in debt based on a financial goal?
Yes, Kavita, see, like you rightly pointed out, that debt is an opportunity which is not worth missing, especially for Indians who have this inner desire to be in fixed deposits. Okay, which is supposed to be an asset class which got twice more money than the entire mutual fund industry. That's one of the estimates. So, point I'm trying to make is debt is an important asset class. Second, debt is an asset class will require a different strategy. Debt may not need diversification if you're going to give it to central government. See, if you're going to lend it to government of India, then I'm not worried about diversification, because the basket, you don't keep all eggs in one basket. But if the basket is so strong that you're lending to the strongest person ever known for an Indian rupee bond, then you don't have to worry too much. So that's diversification not needed if you're lending to government of India. That's point 2. Point 3, in debt, the return itself is low. See, in equity, there's a potential of making 12-15%. Their cost is not so important as much as the cost being important in debt, because you're going to earn 7. You can't pay 2% cost when you're earning only 7. So low cost, concentrated sovereign credit, and indexation and tax benefit can make people 6.5% post-tax if they're ready to hold a target maturity fund for 3 years. A target maturity fund which has a end date and a beginning date. Beginning date, not so much, but an end date of the bond is already fixed. That's called a target maturity fund. Low cost, non-diversified, sovereign credit is a great strategy to make 6.5% post-tax. 6.5% post-tax, Kavita, if you look at it, it is as good as a 10% fixed deposit. For somebody who's got a 30% tax, it's as good as getting a 10% fixed deposit. Tomorrow, if there's a newspaper ad which says 10% fixed deposit, everybody will run to that bank. But Government of India, in effect, is giving you a 10% fixed deposit. So why not choose it?
Talking about fixed deposit, that's a very interesting point that you mentioned. You know why? Because we are getting a lot of questions from viewers where they want to understand if a fixed deposit with a bank or a corporate fixed deposit will be good for them. In this scenario, what are the key points one should consider before deciding what kind of fixed deposit you should be going for?
Kavita, I'm sorry, I might sound very, very myopic or very closed-minded. I would not touch for my money with a barge pole any corporate fixed deposit, because especially retail investors are not capable to understand the credit risk of a corporate, point 1. Second, this is the lowest form of security in a corporate debt. Corporate fixed deposits are unsecured loans. Unsecured loans in the hierarchy, if something were to go wrong with that company, the hierarchy of liquidation, secured debt comes above unsecured debt. So you buying as a retail investor unsecured debt from a corporate which you don't know how to read his balance sheet or understand whether he'll be able to pay you money back is very important that you don't touch. You may lose out on 0.5% return. You may lose out on 1% return, but it's well worth losing that return than playing around with hard-earned monies which you have accumulated over decades of hard work.
So, this is about FD that you've given your take. But then let's talk about different categories in debt, which we have. And the one that's very interesting to know that a lot of investors are interested in credit risk fund. Now, when we talk about debt giving you better return now, since there's been we are seeing interest rate hike and this scenario is likely to continue for a few more times at least. Do you think this category of credit risk fund really makes sense, or you need to be of a different breed, know all the risk angle, and then parking your money in this?
No, Kavita, see, at least if there's a fund manager between the retail investor and your investment, if there's somebody who's a professional, I at least get some calmness that somebody else is evaluating the credit risk. So credit risk fund will certainly score better than a corporate fixed deposit. Second, it will give you that tax benefit unlike a corporate fixed deposit, which will give you interest income. This will give you capital gains and get you indexation. So that's the second advantage if I compare the two instruments which we have just been speaking about. The third is, as long as the credit risk fund has diversified very well, then you don't have to worry too much. So you can buy a credit risk fund. Fourth, your cost should not be too high. See, when Government of India can give you 7.3% on a 10-year investment, which is called the 10-year yield of Government of India, if that's 7.3, that's your birthright as an investor. Now, if the credit risk fund has a return of 10%, but if he's going to charge you 2% cost, then you're back to 8. So then it's not worth it. So a low-cost credit risk fund managed by a large AMC definitely can be of value to get you post-tax extra return, but without you having to worry about the credit risk evaluation.